So imagine inheriting your childhood home, right? But instead of celebrating, you realize the government is, well, they are basically holding it hostage.
Oh, yeah, it is a nightmare. You can't transfer the title. You can't sell
You
it.
can't even access your deceased parents' bank accounts to, pay for the funeral. Not until you somehow produce millions of pesos in cash to settle a massive tax bill.
Right. Which most families just do not have lying around.
Exactly. Welcome to this special exam prep deep dive here on ICPA Review Radio. If you are sitting for the Philippine CPA board exam, that hostage situation I just described is the brutal reality of a state tax.
It really is.
But today, our mission is to completely dismantle the fear around it. We are going to master the mechanics together so you can walk into that testing center with total confidence.
For sure. We are specifically attacking sections 84 through 97 of the tax code today, and we are putting a massive spotlight on the amendments brought in by RA number 18963.
Right, universally known as the train law.
Exactly, the train law. And I'm telling you, examiners heavily favor estate tax. It is a goldmine for them because it allows them to test your grasp of, like, abstract legal theory right alongside rigorous computation.
Oh, they love mixing those two. A single misdeduction, or maybe a misunderstood valuation date, and your whole formula cascades. It will completely derail your final net taxable estate.
Yep, it ruins the whole problem.
So let's start with the tax net itself. I'm looking at the RA 10963 amendments to Section 84, and the very first thing it did was flatten the estate tax rate to a straight 6%.
Which is such a relief for candidates.
I mean, seriously. Before the train law, the CPA boards tested this graduated schedule, right? It penalized larger states with rates going all the way up to 20%.
Yeah, that old table was brutal to memorize.
So economically, I have to ask, did the government just decide to give this massive tax discount to the ultra-wealthy? It feels like they just gave up.
Well, it definitely looks that way on a surface reading. But you have to analyze the historical collection data behind that amendment. I mean, when the top rate was 20%, tax compliance in the Philippines was just abysmal.
Like people just weren't paying it.
Barely anyone was paying. Heirs were simply not declaring the deaths of property owners. They would literally hold properties in the names of their deceased grandparents for decades.
Oh, wow. Just to avoid that crushing 20% tax burden.
Exactly. So the BIR realized that a highly theoretical 20% on paper brings in way less actual revenue than a realistic, manageable 6% in practice.
Yeah, that makes sense.
By dropping the rate to a flat 6% of the net estate, the train law basically removed the incentive for tax evasion. They were essentially begging families to, finally update their property titles.
So it's a volume play by the BIR. Lower the barrier to entry so more people actually pay into the system. And honestly, that flat 6% makes the math on the exam infinitely easier for you, the candidate.
Oh, it's...
But before you can multiply anything by 6%, you need the base value. That brings us to Section 88, which dictates valuation. Now, the general rule is simple enough. Everything is appraised at fair market value at the time of death.
Right. Time of death is the anchor.
But let's look at real property, because the Board of Accountancy is never going to hand you just one clean value for a piece of land and a multiple choice question. They're going to make you work for it.
They will deliberately feed you conflicting data. That is a classic exam trap. You're going to see the fair market value determined by the commissioner, which is the zonal value.
Okay, the zonal value.
Right. And then right next to it, in the problem, they will provide the fair market value shown in the schedule of values fixed by the provincial or city assessors.
The local value. So you have a national BIR value and a local government value.
Exactly. The tension exists because local government units just assess property values differently than the national BIR does.
So as a test taker, I always map this out by assuming the government wants the biggest piece of the pie possible, right? So I should assume we pick the higher of those two numbers to maximize the gross estate.
That is the exact statutory rule. You always select whichever is higher between the commissioner's zonal value and the assessor's value.
Whichever, sire. Got it.
So if the BIR's zonal value is $5 million, but the local assessor lists it at $7 million, your gross estate absorbs the $7 million. End of story.
Okay, and what about shares of stock? That comes up a lot, too.
Yeah, be very careful with shares of stock. If they are listed on the local exchange, you actually have to use the arithmetic mean between the highest and lowest quotation on the day of death.
The average for that specific day.
Right. And for unlisted common shares, you value them at book value. But unlisted preferred shares, those are valued at par value.
Book for common, par for preferred. That is definitely going to be a multiple choice question. So let's move on to what actually goes into this giant net we call the gross estate under Section 85.
This is where we divide the world into two categories.
Based on citizenship and residency, right. So if the decedent was a resident citizen, a non-resident citizen, or a resident alien, the BIR casts a global net.
A completely global net. Property wherever situated.
So a condo in Makati, a bank account in Zurich, a car in Tokyo, it all goes in.
Every single piece of it. But if your decedent is a non-resident alien, or NRA, that net shrinks dramatically.
Right, because they aren't citizens and they don't live here.
Exactly. For an NRA, only the property situated physically within the Philippines is included in their gross estate.
Yeah.
And honestly, that sets up one of the most frequently tested areas on the exam.
Intangible personal property, right.
Yes, because physical property is easy to locate. A house in Cebu is in the Philippines. But what if a non-resident alien owns shares in a Philippine corporation? Where does that sit?
I mean, they are living abroad, but the company is here.
Exactly. The general rule is those shares have a situs in the Philippines, so they are included in the gross estate.
Okay, but there's an exception, isn't there?
A huge one. The exam will definitely test you on the rule of reciprocity. If the foreign country of that non-resident alien does not impose an estate tax on Filipinos, or if they allow a similar exemption, the Philippines will not tax those intangible assets either.
Oh, I see. It's like a mutual professional courtesy between nations. You don't tax our citizens, we won't tax yours.
Exactly, reciprocity. So
Yeah.
always scan the problem to see if the NRA's home country has that mutual exemption.
Got it. Now, I want to push back on some of the specific inclusions in Section 85, particularly transfers in contemplation of death and revocable transfers.
Oh, these trip people up all the time.
Because the concept feels inherently contradictory. If I transfer a property to my daughter before I die, the title changes hands. It's in her name. I literally no longer own it. How on earth does the BIR justify pulling an asset I don't legally own back into my gross estate?
Well, it's because the tax code prioritizes economic substance over legal form.
Yeah.
We call this the invisible string concept.
The invisible string. I like that.
Yeah. You might have transferred the legal title, right? But if you retained the right to the income from that property, or if you kept the power to alter, amend, or completely revoke that transfer at any point before you died, you never truly let go.
Ah, so I was still pulling the strings.
You were still holding the string. The law treats that transfer as essentially a fake out. It only truly takes effect when you die because your power to revoke dies with you.
Right, right.
Therefore, the BIR says, nope, that property value is pulled right back into the gross estate.
Okay, let's test that invisible string with an exam scenario. Let's say I know the end is near, I'm sick, and I decide to sell my 10 million peso commercial building to my son for, let's say, 100 pesos.
Okay, a bargain sale.
Right, but it's a sale, not a donation. The title transfers unconditionally. I have absolutely no power to revoke it. Have I successfully cut the string and removed it from my estate?
Nice try, but no.
Ah.
The BIR anticipated that exact loophole. That brings us to the rule on insufficient consideration.
I knew there was a catch.
Oh, always. If a transfer is made in contemplation of death, or is revocable, but you sold it for less than adequate and full consideration in money's worth, the gross estate must include the excess.
The excess of what?
The excess of the fair market value at the time of death over the value of the consideration you actually received.
So in my scenario, the property is worth 10 million at my death. My son only paid me 100 pesos. That means my gross estate still has to include 9,999,900 pesos.
Exactly. The tax net catches it anyway. It catches the uncompensated value, completely preventing you from disguising an inheritance as a bargain sale.
That is a phenomenal trap to watch out for. Make sure you check the consideration value, guys. Now let's look at life insurance under Section 85E. The rules on whether insurance proceeds are taxable or exempt seem to hinge entirely on just a couple of specific words in the policy.
You are absolutely right. The crucial variable here is the designated beneficiary.
Okay, so who gets the money?
Right. If the policy names the estate of the deceased, the executor, or the administrator as the beneficiary, the proceeds are automatically included in the gross estate.
Automatically.
Automatically. And it does not matter if the designation is revocable or irrevocable.
Wait, I need to clarify the logic there. Why doesn't irrevocability save the insurance proceeds if they go to the estate?
Well, because the estate itself is the taxable entity. If the money flows into the estate, it is being used to enrich the estate or pay off its debts.
Oh, so it's effectively increasing the net worth of the deceased's pool of assets.
Exactly. Therefore, it is part of the taxable base.
That.
No way around it.
But if the beneficiary is a third party, let's say I name my sibling instead, the rule shifts, right?
Yes. If a third party is named, the proceeds are included in the gross estate unless the policy expressly stipulates that the designation of the beneficiary is irrevocable.
Expressly stipulates it has to say it.
It has to say it. If the problem states the designation is irrevocable, that invisible string is fully severed. You lost all control over that policy during your lifetime, so the proceeds completely bypass the gross estate.
Wow, okay. But I have to pay close attention to the wording on the exam then. What if the problem is completely silent? It just says life insurance proceeds to sister and says nothing about revocable or irrevocable.
That is the trap. If it is completely silent, Philippine insurance law presumes the designation is revocable.
Ah, silence means inclusion.
Yes, silence means inclusion. If you don't explicitly see the word irrevocable in the multiple choice question, you have to add those insurance proceeds to your computation.
That is a great tip. Okay, so if the gross estate is everything caught in the net, applying 6% to that massive total would basically bankrupt most families.
It definitely would.
The law has to provide relief, which transitions us naturally into the deductions under Sections 86 and 87. How do we legally carve down this massive gross estate to arrive at the net taxable estate?
We start with the single largest statutory relief mechanism, the standard deduction. And the Train Law drastically altered this landscape.
Oh, it really did.
For a citizen or resident of the Philippines, the state is now automatically granted a standard deduction of 5 million pesos.
Just flat out.
Flat out. No substantiation required. You do not need to present a single receipt to the BIR.
That is incredible because prior to Train, that deduction was only 1 million pesos. A 400% increase is just staggering. What was the legislative intent behind jumping it to 5 million?
It was basically a direct response to inflation and the skyrocketing values of real estate in the country. A 1 million peso deduction was trapping lower middle-class families, families who maybe just owned a modest home and had a small savings account.
Right, ordinary people.
Yeah, and is dragging them into complex tax audits they simply couldn't afford to deal with. By bumping it to 5 million, the BIR essentially removed the vast majority of ordinary middle-class estates from the tax base entirely.
So it lets the agency focus its auditing resources on actual high net worth individuals.
Exactly. It's an administrative efficiency move.
But this generosity has limits, doesn't it?
It-
If the decedent is a non-resident alien, an NRA, that standard deduction drops.
It drops off a cliff, from 5 million down to a mere 500,000 pesos.
Oh, man. 5 million for citizens, 500K for NRAs. That asymmetry is a highly testable distinction on the board exam.
Mark my words, they will test that difference. And beyond the standard deduction, you also have the family home deduction.
Let's talk about that.
If the decedent leaves behind a family home, the estate can deduct an amount equivalent to the current fair market value of that home, up to a maximum statutory limit of 10 million pesos.
Okay, so to map the math on that for the listener, if the family home is valued at 8 million, you just deduct the full 8 million.
Correct.
But if the home has a fair market value of, say, 15 million, you are strictly capped at a 10 million peso deduction, meaning that remaining 5 million stays trapped in the taxable estate.
That is perfectly stated, and the examiners will test the conditions for this too. The family home must be certified by the barangay captain, where it is physically located.
Oh, good detail.
And crucially, if the family home is part of conjugal property, meaning owned by both husband and wife, you only deduct the decedent's half of the value against that 10 million limit.
Right, because you can't deduct what the dead spouse didn't own. Okay, let's shift to liabilities. Section 86A2 covers claims against the estate. If someone dies with massive debts, it is only logical that the estate pays off the creditors first, and the government only taxes whatever equity is actually left over.
Right. Logic dictates that. But the BIR operates on extreme skepticism.
I can imagine.
The government assumes families will just fabricate debts, like maybe writing up a fake promissory note to an uncle just to create a fake deduction and lower their tax bill.
To zero out the estate.
Exactly. To combat this fraud, the law requires very strict formalities. For a debt to be deductible, the debt instrument must have been duly notarized at the exact time the indebtedness was incurred.
So an unnotarized promissory note is just worthless on the exam.
Completely worthless. Do not deduct it. Furthermore, if the loan was contracted within 3 years before the death of the decedent, the administrator must submit a formal statement showing the actual disposition of the loan proceeds.
Meaning they have to show where the money went?
Exactly. The BIR is demanding a paper trail. They want undeniable proof that you didn't just borrow 5 million pesos to quietly hand the cash to your children tax-free right before you died.
Wow. You really have to prove where the cash went. Okay, let's tackle the concept that traditionally causes CPA candidates to just completely panic.
Let me guess. Property previously taxed.
Yes. Specifically, the vanishing deduction under Section 86A5. The computation on this can be absolutely brutal if you don't understand the underlying mechanism.
Well, the mechanism basically exists to mitigate the harsh economic impact of rapid successive deaths within a single family.
Like dying back to back.
Yeah. Imagine a father dies and leaves a highly valuable commercial farm to his son. The father's estate pays the 6% tax on it. But if the son tragically dies in a car accident, just say 18 months later, that same farm is now part of the son's gross estate.
And it gets taxed again.
Right. Taxing the exact same property at full value again within such a short window would rapidly confiscate a family's wealth. It's unfair.
So the government steps in and offers a grace period, effectively acknowledging that the wealth hasn't really had the time to regenerate. I actually use a mnemonic for this, the 5-year staircase. The deduction tapers off over exactly 5 years. Can you walk us through those percentages?
Absolutely. The staircase is 100, 80, 60, 40, 20.
180, 60, 40, 20?
Okay. If the second death occurs within 1 year of the first death, you deduct 100% of the value of that previously taxed property.
Full deduction.
Full deduction. If the death is more than 1 year but not more than 2 years, you drop to 80%. More than 2 but not more than 3 years is 60%. More than 3 but not more than 4 years is 40%. And more than 4 but not more than 5 years is 20%.
Got it. And what if the second death happens 5 years and like 1 day after the first?
The deduction vanishes completely. It drops to zero. The economic assumption is that 5 years is sufficient time for a family to utilize the asset, generate new income, and recover the initial tax cost.
That makes a lot of sense. 180, 60, 40, 20. Just count it out on your fingers during the exam, guys.
Yep. It's the easiest way.
Now let's look at how deductions work for a non-resident alien. We already established they only declare Philippine properties in their gross estate. Because their tax base is restricted, Section 86B restricts their deductions through proration.
Right. You have to calculate what we call the NRA proportion formula.
How does that work?
Well, you take the Philippine gross estate and you divide it by the total global gross estate. This gives you a percentage representing the Philippine footprint, basically.
The ratio of what's here versus what's everywhere else.
Exactly. You then multiply that exact percentage by the total global deductions for claims, mortgages, and losses. So if 30% of their total wealth is in the Philippines, they can only deduct 30% of their total allowable debts against the Philippine estate.
It matches the deduction strictly to the proportion of the estate being taxed.
Very logical.
I should.
Okay, let's cover exemptions quickly. Section 87 highlights transfers for public use and transfers to social welfare, cultural, and charitable institutions. What is the caveat candidates must look out for here?
Well, the charitable exemption is massive, but it comes with a strict administrative cap. The law mandates that no more than 30% of the bequest can be used by the charitable institution for administrative purposes.
Oh, so if an estate leaves 2 million pesos to a foundation, that foundation cannot just siphon off 1 million to pay its executive salaries and office rent. Exactly. At least 70% must be deployed directly toward the actual charitable mission. If they violate that 30% admin cap, the entire exemption is nullified, and the 2 million becomes fully taxable.
Ouch. Okay, before we finally calculate the tax, we have to address the living spouse under Section 86C.
Right. You can't forget the spouse. When you tally up the conjugal or absolute community property, you are looking at assets owned by both spouses equally.
But the estate tax only applies to the deceased.
Precisely. Therefore, before arriving at the final net estate, you absolutely must deduct the net share of the surviving spouse, which is exactly 1/2 of the conjugal net estate.
You cannot tax the living spouse on wealth they legally already own. So we've built the gross estate, we've carved it down with standard deductions, the family home, notarized debts, the vanishing staircase, and the spouse's share.
We apply our flat 6% rate, and boom, we have computed the tax.
But mastering the computation is really only half the battle on the boards. Knowing the rigid administrative rules on when and how to file is where examiners will really test your attention to detail.
Yeah. Section 90 governs the estate tax returns, and under the Train Law, the timeline for filing was significantly relaxed.
Really? How so?
Well, the return must now be filed within 1 year from the decedent's death.
1 year. It used to be 6 months, right?
Yeah, so that 1 year mark is a critical RA 10963 update. Make sure you don't use the old 6-month rule. But within that filing requirement, there is a specific threshold regarding CPA certifications that is a notorious exam trap.
I know exactly what you're talking about.
The law dictates that a state tax return showing a gross value exceeding 5 million pesos must be supported by a statement duly certified by an independent CPA.
The word exceeding is the trap here, isn't it? If I'm looking at a multiple choice question and the problem states the gross estate is exactly 5 million pesos, do I need to attach a CPA certificate?
No, exactly 5 million does not exceed 5 million.
Right.
The requirement triggers at 5 million and 1 centavo. Examiners construct problems hitting that 5 million mark precisely, just to see if you understand the absolute boundaries of the threshold.
Tricky, tricky. Okay, Section 91 handles payment. The general doctrine is pay as you file. But, as we discussed, estates are notoriously illiquid. You might inherit a massive commercial building, but have absolutely zero cash in the bank to pay the 6% tax on it.
It's super common. The law finally acknowledges this liquidity crisis. RA 10963 introduced the option to pay by installment within 2 years from the statutory date for its payment, without any civil penalty and interest.
That's a huge help. But what if installments are enough because the estate is, tangled up in messy legal disputes among the heirs?
Then the commissioner can grant formal extensions.
The timeline for those extensions depends entirely on how the estate is being settled, doesn't it?
Correct. If the estate is settled extrajudicially, meaning the heirs are simply hashing it out privately out of court, the extension to pay is up to 2 years.
2 years for extrajudicial.
But if the estate is settled judicially, meaning it's dragged into the court system, which is, let's be honest, notoriously slow, the extension could stretch up to 5 years.
Okay, 2 years extrajudicial, 5 years judicial. Memorize that. Now, let's address the most practical, real-world consequence of death in Philippine taxation, what I like to call the BIR freezer.
Oh boy, the freezer.
Historically, the moment the bank found out someone died, their accounts were just frozen solid. Families couldn't withdraw a single centavo to pay for medical bills or funeral costs until they presented proof that the estate tax had been paid in full. It caused unimaginable distress.
It really did. Section 97 used to enforce that freeze ruthlessly. However, RA 10963 engineered a highly pragmatic solution. It is often referred to as the defrost mechanism.
How does the defrost work?
If a bank has knowledge of the death of a person who maintained an account, whether it's a sole account or even a joint account, the bank will now actually allow withdrawals from that deposit account before the estate tax is settled.
Wait, they can just walk in and take the money?
Yes, but subject to one massive condition. The bank acts as the withholding agent. They will subject any withdrawal to a final withholding tax of 6%.
Ah, I see. It's an elegant compromise, really. It solves the immediate cash crisis for the grieving family, but by instantly withholding 6%, the BIR perfectly secures its exact estate tax rate up front.
Without having to chase the heirs down later, exactly. And for joint accounts, the withdrawal slip just needs a sworn statement that the other joint depositors are still alive.
It is heavily tested on the CPA exam because it perfectly marries real-world banking practice with tax compliance.
We definitely expect to see it.
Well, we have covered immense ground today, dissecting everything from the global tax net to the 6% bank withdrawal. As you prepare to sit in that testing center, let's synthesize this into our exam day checklist. Give us the 4 non-negotiable takeaways you need to memorize.
All right, get your pens ready. First, lock in the rate. Estate tax is a flat 6% of the net estate, completely neutralizing the old graduated scales.
6% flat.
Second, on valuation. Always pick the higher amount between the commissioner's zonal value and the local assessor's fair market value.
Always in the higher one.
Third, burn the train law limits into your memory. A 5 million peso standard deduction for citizens and residents, but only 500,000 for non-resident aliens. The family home maxes out at 10 million, and you only need a CPA certificate if the gross estate strictly exceeds 5 million.
Right.
Finally, on administration, you have 1 year to file the return. Extensions to pay are 5 years for judicial settlements and 2 years for extrajudicial.
And 180, 60, 40, 20 for the vanishing deduction. Just count it on your fingers.
Exactly.
Before we wrap up, I want to leave you with an unexplored thought regarding these rigid limits we've discussed today. The train law intentionally set these massive deductions, 5 million for the standard, 10 million for the family home to protect the middle class, right?
Right, that was the goal.
But these limits are fixed numbers written into the law. They are not pegged to inflation. With real estate prices surging the way they are, how long will it be before a standard, modest family home in Metro Manila easily breaches that 10 million cap?
Oh, it's happening already.
Exactly. Unless the legislature actively amends these fixed figures in the future, inflation will silently drag ordinary middle-class families right back into the estate tax nightmare the Train Law was designed to save them from. The law might be static, but economics never stops moving.
That is a phenomenal reminder that tax law is constantly engaged in a race against economic reality.
Wishing you phenomenal focus on your review. You have the mechanics, you understand the intent behind the rules, and you are totally ready for whatever trap the examiner set. Thanks for joining this deep dive on ICPA Review Radio. Go conquer that board exam.